Hello everyone, let's study Ind AS 1, Presentation of Financial Statements. If you have done all other standards, this presentation of financial statements, you feel very basic and it's going to be a cakewalk for you. But it is very important from the exam point of view. So in this video, we are going to discuss all the study material questions, all illustrations, TYK and the additional practice questions added. And here our strategy will be, first we'll do the questions and then from the questions we connect to theory. From the questions we'll study the provisions. Okay, so maximum it will take 1 to 1.5 hours. So let's start the session. Time being, we are not touching the theory. Theory is super easy, but we'll do the questions. Question number 1. An entity prepares its financial statements that contain an explicit, unreserved statement of compliance with Ind AS. What is this? A set of financial statements contain an explicit, unreserved statement of compliance with Ind AS. However, the auditor report on those financial statements contain a qualification. Oh, the management say the financial statements comply with Ind AS, but auditors report on those financial statements contain a qualification because of the disagreement on application of one accounting standard. In such case, is it acceptable for the entity to make an explicit, unreserved statement of compliance with Ind AS? Yes. Management should prepare financial statements following Ind AS 1. Okay. What is given as per Ind AS 1? What is given? Shall we study the related theory? What is given as per Ind AS 1? Okay, let me see. General features of a Ind AS financial statement. So first, the standard says it gives the requirements for presentation, guidelines for the structure and minimum requirements for the content. Now, financial statements means both separate and consolidated financial statements presentation is covered in the standard, not interim financial statements. Both separate, consolidated, but not interim, because interim we have a dedicated Ind AS for that. What is the dedicated Ind AS for interim financial statements? Ind AS 34, right? And complete set of financial statements comprise of a balance sheet or statement of P&L, statement of changes in equity, statement of cash flows, notes to accounts, and opening balance sheet. You have couple of questions coming up. When do you require to prepare an opening balance sheet? When do you require to prepare an opening balance sheet? Opening balance sheet is prepared when? When do we prepare this opening balance sheet? Opening balance sheet is prepared 1. When there is a change in accounting policy. Change in accounting policy with retrospective effect. I am changing an accounting policy which I was following for last 15 years. So go back to 15th year and make the corrections. Cumulative effect you need to give, and you should start accounting from the beginning of previous year. Beginning of previous year. You need to start giving the effect from the beginning of previous year. So if current year ending is 31st March 25, you need to give previous year financial statements, of course. This is compulsory, 1 year comparatives, and also 1st April 23, because 15 years before you started changing the figures, but the effect you are accounting from the beginning of previous year. So when there is a change in accounting policy with retrospective effect, you need to present a third balance sheet. That is third balance sheet. Normally we prepare for current year, previous year and beginning of the previous year. Okay. Then 2. Correction of a prior period error. Correction of prior period errors. Restatement of prior period errors. Okay, there were errors, and error you corrected, and when you give the correction, you should start accounting it from, if it affects 31st, if the error is in 31st March 25, then I need not make an announcement regarding the error. You can correct it. If the error is in the previous year, then again, your third balance sheet is not required. Correct the error in this year, and accordingly that correction will be reflecting in the current year also. Error is not current year and previous year, but before that. Then you need to make the third balance sheet. Then you need to prepare the third balance sheet. I hope you are following. Then you need to prepare the third balance sheet. Okay. Then reclassification of items in the financial statements. Reclassification of items in the financial statements. So it's actually written. What are we discussing? We started in Ind AS 1. You read illustration 1, but where are we right now? I'm just starting with the theory. A complete set of financial statement includes, I hope you're all studying. Okay. It includes a balance sheet, yes, statement of P&L, statement of change in equity, statement of cash flows, notes. Now read this. Opening balance sheet only when the accounting policy has been applied retrospectively, or retrospective restatement or reclassification of items in the financial statements made. Okay, so actually our area is this general features. I want to come to this general features, but before that I thought, rather than just jumping to general features, what is there in the initial paragraphs? I just wanted to read. So this is okay. Now structure and content. An entity should clearly identify each financial statements and the note it should display. As per Ind AS 1, a financial statement should have name of the reporting entity, of course. Whether the financial statements are individual or group of entities. You should name it as individual statements or group. I didn't understand. Okay. Now there is a limited company. A limited is having a subsidiary or an associate or a joint venture, then it should compulsorily prepare what? Consolidated financial statements. Consolidated financial statements. And if A limited is independently preparing, not consolidating the financial statements, then A limited's financial statements is called as separate financial statements. Yes. Now there is a limited. That A limited does not have a subsidiary, poor A limited does not have an associate, does not have a joint venture. Then A limited's financial statements is separate financial statements. No, A limited's financial statements is called as individual financial statements. Are you getting? So if it is individual or separate or consolidated, you should give the heading individual, separate or consolidated. Yeah, name of the reporting entity, whether financial statements are individual entity or group of entities. Now, the balance sheet dates and the reporting period covered, of course. Presentation currency. Level of rounding used, thousands, hundreds. Yeah, okay. Easy. Now general features. All in these areas, I'm not taking effort, which means not me as a faculty, but students need not take efforts to memorize the points. Are all easy. That's what I'm trying to say. Now, what are the general features of a financial statements? I feel this is important. Presentation of true and fair view and compliance with Ind AS. Presentation of features of financial statements should be true. It should present true and fair view and compliance of Ind AS. Faithful representation of effects of transactions. Transactions should be faithfully represented. And see this point, what is given? Explicit and unreserved statement of compliance in the notes. You should comply with Ind AS and you should make an explicit and unreserved. Okay, we followed Ind AS, but we couldn't follow this. That should not be there. Explicit and unreserved. There should not be any reservations. Explicit and unreserved statement of such compliance in the notes. Then third point is something which if you remember AS1, it is there in AS1. Inappropriate accounting policies are not rectified just by disclosing it. Disclosure will not remedy a wrong or inappropriate accounting treatment. I made a mistake. I made a non-compliance of Ind AS, but I disclosed it. So what's the problem? Don't say that. It will not remedy. You have to face the consequence of non-compliance. And in extremely rare circumstance, if there is a departure from the Ind AS, then that appropriate disclosures are to be required. Okay, just to satisfy some other statute, I had to deviate from the Ind AS, then appropriate disclosures are required. Okay, so a financial statement should be faithfully represent the transactions, should have explicit and unreserved statement of compliance of all the Ind AS. Inappropriate accounting policies are not rectified by disclosing it. In extremely rare circumstance, if you have to deviate from the Ind AS to achieve fair presentation, that appropriate disclosures are to be done. Okay, so the question, we are coming back to question number 1. Auditor has made a qualification in the report. So can I present it? Can I show that explicit unreserved statement of compliance of Ind AS in the notes? Yes, because that is to be made by the management. Being the management, have prepared financial statements for complying all the Ind AS. But auditor has some disagreements. Let him qualify the report. That's it. The entity should have followed all the Ind AS. If the auditor has any disagreements, let him qualify the report. That's it. So, is it acceptable for the entity to make explicit and unreserved statement of compliance of all the Ind AS? Yes. Now the next area in the study material is going concern. Going concern, they have written some notes and illustration to a big question. Illustration 2, and illustration 2 is a big question, but before moving on to the illustration, let me read that relevant theory. Going concern. What is given regarding this going concern? All financial statements are prepared on going concern basis. Of course, you have studied maybe from the 11th standard or foundation fundamental accounting assumptions, going concern. All entities should prepare financial statements following going concern basis. Unless the management either intends to liquidate the entity or terminate the business. Okay. If not going concern, if you are preparing financial statements not following going concern, disclose the basis of preparation of financial statements and reason why you are not following going concern principle. Or if there are doubts regarding going concern, that also you disclose the uncertainties. Okay. And with regard to that, there is a question which as I said, I'll cover all the questions. So let me read this. So if you don't have the study material, also it is fine. It appears to be a big question, but the contents are very easy. So just relax and watch. Entity XYZ is a large manufacturer of plastic products for the local market. Okay, we manufacture plastic products. On 1st April 16, the newly elected government unexpectedly abolished all import tariffs, including 40% tariff on all imported plastic products. Oh, many other economic reforms implemented by new government contributed to the value of the country's currency, rupee, appreciating significantly against most other currencies. Okay, fine. So we were manufacturing plastic products for the local market, and import tariffs were all abolished. As a result, there will be more imports of plastic products. Yes or no? And the currency also strengthened. The currency appreciation severely reduced the competitiveness of the entity's products. Okay, imported products are easily available now because rupee also strengthened. Before 2016, entity XYZ was profitable. Oh, However, because it was unable to compete with the low-priced imports, entity XYZ went into losses. Quite natural, no? Quite natural, quite natural. As at 31st March 2017, entity XYZ's equity was 1,000, net assets was 1,000. During the second quarter, the management restructured entities' operations. The restructuring helped reduce losses for the third and fourth quarters to 400 and 380 respectively. Okay, reduce losses. During the year ended 31st March 17, entity XYZ reported a loss of current year. We have a total loss of 4,000. In January 17, the local plastic industry and labor union lobbied government to reinstate tariffs on plastic. So as usual, so some businesses are severely affected because of this abolishment of this import tariffs, and we have influenced government and we are planning to reinstate tariffs on plastic. On 15th March, the government announced that it would reintroduce limited plastic import tariffs at 10% in 2018. Earlier it was 40% but 10%. However, it emphasized that those tariffs would not be as protective as the tariffs enacted by the previous government. In its latest economic forecast, the government predicts a stable currency exchange rate in the short term with a gradual weakening of the jurisdiction's currency in the longer term. So government has promised now there will be a 10%. Government will be reintroducing 10% import tariff and the currency will be stable. Now currency fluctuation will be stable. There won't be currency, rupee will not strengthen. Okay. The management of the entity XYZ undertook a going concern assessment because if the company continue to make losses, it may have to liquidate. So 31st March 17, it undertook a going concern assessment. Management projects or forecasts that imposition of 10% tariff on import of plastic products would at current exchange rates result in entities XYZ returning to profitability. Our future may not be as bright as before, but still we can return to profitability, which means is the company liquidating or is going concern inappropriate or going concern affected? No. How the management of entity XYZ disclose the information about going concern assessment in the annual financial statements, which means current year the company is actually affected by that abolishment of tariff and strengthening of rupee. So it was doubtful initially, but at the end, while doing the assessment, company will be returning to what? Profitability. So because we have gone for an assessment of going concern, what are the disclosures required? So when the company has a doubt of going concern, it should go for assessment and should make disclosures in the notes to account. So what are the disclosures to be made? So disclosure, listen, just copying and pasting the information from the question. So tomorrow if you get a 2-page question for exam, don't get confused at all. First you write about going concern, 2-3 lines from the book, from what I have shown you. You can write 2-3 lines about going concern and then disclosure. Disclosure is nothing but copying and pasting the information from the question. So on the basis of management's assessment, financial statements have been prepared on going concern basis. However, the management assessment assumes that government will reintroduce and currency exchange rate will remain constant. Okay. All these are information copied and pasted. Provided rupee does not strengthen, management projects forecast that a 10% tariff on all would result returning to profitability. Everything. Current net assets is 1,000. Okay. On the basis of the assessment, management believes that entity XYZ is a going concern. So my intention was just to introduce the question to you. Once you have seen the question, you will be all right. If you have not seen the question, there can be a confusion in the exam hall if you get this one. So that's it. So accrual basis, materiality and aggregation, offsetting. We have a question in TYK or practice questions also regarding offsetting. Can you offset an income and expense? Can you offset asset and liability? You can offset asset and liability or this as income and expense only if it is not affecting the substance of the transaction. It should not affect the substance of the transaction. Offsetting. Regarding offsetting, just one line what is written. So, entity should not offset assets and liabilities, income and expense unless required by. Entity should not offset assets and liabilities or income and expense unless required by Ind AS. See, that is if you have a trade receivable X and you have same X as a trade payables. Trade receivables 50,000, trade payables 10,000. You can offset. There is legally enforceable rights to set off. Okay, so if it is same party, you can set off, or same nature of income and expense, you can set off. For you are getting the same, you are getting an income and you are incurring an expense for the same transaction, you can set off. But if it is material, you should make the disclosure. So, what is the question here? Is offsetting. Is offsetting of revenue against expenses permissible in case of a company acting as an agent? I am an agent and I have sub-agents. Oh, understood. So I am an agent getting commission and I'll be paying commission to the sub-agent. Can you set off? It will not show the true substance of the transaction. My financial statements should show that I have an agent, I have a sub-agent. So agent should recognize full commission and should pay sub-agent's commission, that which should be shown as an expense. My commission and sub-agent's commission should appear as an expense. It should not be set off, knocked off. Okay, so the amount of commission paid by to the sub-agent should be considered as an expense, should not offset. So agent's revenue should come as gross revenue. Yes. So just for your understanding now, an entity should present two balance sheets. Two balance sheets, current year, previous year. Minimum. If you want more, you can present. It is optional. It is up to you. But minimum two balance sheets compulsory, two P&L, two cash flows, two statement of change in equity, current year, previous year, and related notes. If you are showing current year balance sheet and previous year balance sheet, notes of current year and previous year should be presented. Okay, and opening balance sheet when there is a retrospective change in accounting policy, retrospective application of change in accounting policy, retrospective restatement of errors, retrospective reclassification of items in the financial statements. So additional comparative information, minimum comparative 1 year you should do. Additional comparative information welcome. If you want to do, you can show, that's it. Now, yeah, illustration number 4. A retail chain acquired a competitor in March 2011 and accounted for the business combination under Ind AS 103 on a provisional basis in its 31st March 2011 annual financial statement. So, retail chain acquired a competitor, business combination. The business combination accounting was finalized in 11/12 and the provisional fair values were updated. Do you remember Ind AS 103? Our relevant area measurement period? You can do fair valuations on provisional basis. Later, there is a window period of 12 months given to correct. Yeah. And the provisional fair values were all updated. As a result, 10/11, the comparators were adjusted in 11/12 annual financial statements. Does the restatement require an opening statement of financial position? Statement of financial position means balance sheet. So when you prepare this balance sheet and there is business combination, do you need to prepare the opening third balance sheet? Such an area is not given in the standard. If not given, please don't do it. No need. No need. Third balance sheet is required only in 3 scenarios. So that is explained. So here it is not required. So let me show the answer. It is the additional statement of financial position is not required because the acquisition had no impact on the entity's balance sheet as at 1st April. It is not affecting anything as at 1st April. Not required. Okay. Now, question number 5. When we are coming to question number 5, I think our majority of the questions are on this area. Current assets, non-current assets. So, is it important to identify current assets, non-current assets? Yes. So, what is a current asset? What is a non-current asset? My standard explains what is a current item. Asset which is expected to be realized in normal operating cycle. What is this normal operating cycle? What is operating cycle? The cycle in which cash is converted into cash. Like you procured raw materials. Raw materials are used in production, so it is in working progress stage. Then it has turned into finished goods. Then you make sales, that is what receivables, and ultimately you are receiving cash. So you spend cash to buy raw materials and finally it is coming back as cash. How much time it is required to convert the cash to cash? That is what one operating cycle. So expected to be realized in the entity in normal operating cycle. So the kind of questions are, if the operating cycle is 20 months, it is current asset. 28 months, there is a question with 28 months, current asset. So current assets are assets which are expected to be realized in entities normal operating cycle. Held primarily for trading. Assets which are held for trading are current assets. Assets which are expected to be realized within 12 months. Generally we use this. But if it is within normal operating cycle also, it's fine. Cash or cash equivalent. Similarly, liability expected to be settled in normal operating cycle, held for trading, expected to be settled within 12 months. So generally, we don't have unconditional right to defer settlement of liability for 12 months. We'll see this point later in a question. Okay, wait. All other liabilities are required to be classified as non-current. Okay, question number 5. Listen, very basic. X Limited provides the following: raw material holding period 3 months, work in progress holding period 1 month, finished goods holding period 5 months, debtors collection period 5 months, 3 plus 1, 4 plus 10, 14 months is your normal work operating cycle. Inventory or trade receivables are normally realized in 15 months. So if it is expected to be 15 months because that is the normal operating cycle, then it is current. Okay. B Limited produces aircrafts. The length of the time between first purchasing raw materials to make the aircraft and date the company completes the production and delivery is 9 months. So it is 9 months. The company receives payment of aircraft again or 7 months time after delivery. So 16 months is the normal operating cycle. How should it treat the inventory and debtors? Current. Expected to be settled within one normal operating cycle is current. Now, question number 8. On 1st April 2013, Charming Limited issued 1 lakh bonds of rupees 10 each. 10 lakhs is the value of bonds. On 1st April each year, interest at the fixed rate of 8% per year is payable on outstanding capital amount of the bonds. So on 1st April, which means not year end, the very next day you need to settle the interest, 8% interest. So first year interest is 80,000. The first payment will be made on 1st April 14. On 1st April each year, that is from 1st April 14, Charming Limited has a contractual obligation to redeem 10,000 of the bonds at rupees 10 per bond. Oh, so you have a total bonds of 10 lakhs, financial liability of 10 lakhs, of which 1 lakh is expected to be settled in 12 months. Yes or no? Contractual obligation to redeem 10,000 of the bonds every year. So 1 lakh is current. Balance 9 lakhs is non-current. So how should this be presented? Present 1 lakh as current, present interest payable also as current, the rest 9 lakhs as non-current. Okay. X Limited provides you the following information. Same 3 plus 1 plus 5 plus 5. Trade payables will be paid in, so 3 plus 1, 4. 14 months is the operating cycle. Trade payables will be settled in 12.5 months. Yes, it is current. So this is so basic. If a foundation student sees this questions, they feel CA final is very easy. Especially financial reporting is very easy. Yeah. Entity A has two different businesses. Entity A has two different businesses, a real estate and manufacturing of passenger vehicles. With respect to real estate business, the entity constructs residential apartments for customers and normal operating cycle is 3 to 4 years. Okay, for residential apartment, your operating cycle is 3 to 4 years. With respect to business of manufacture of passenger vehicles, normal operating cycle is 15 months. Under such circumstances, where an entity has different operating cycles for different types of businesses, how classification into current and non-current be made? So take one asset. If it is related to real estate, then you check real estate, then operating cycle is 3 to 4 years, current. An asset which is related to manufacturing of vehicles, within 15 months if it is expected to be realized, current. That's it. An entity can have different businesses. Every business can have different operating cycles. So consider each asset and liability and accordingly identify whether it is current or non-current. That's it. So as per Ind AS 1, an asset should be classified as current if an entity expects to realize the same within a normal operating cycle. A liability should be classified as current. Okay. In this situation, where business have different operating cycle, classification of asset or liability as current or non-current would be in relation to the operating cycle that is relevant to that particular asset or liability. It is advisable to disclose the normal operating cycles of both the different business for better understanding. Okay. Now illustration 11. See, if I take only illustration 11, some questions which I feel as important, if I mark and do, you think there is something else in the study material. Just to avoid that confusion, I thought I'll quickly read all the questions. Okay, illustration 11. An entity has placed certain deposits with various parties. How the following deposits should be classified? Current or non-current? Okay, electricity deposit. How can I say it is current or non-current just by seeing electricity deposit? It depends on the terms. Okay, if it is expected to be realized within 12 months, it is current or else non-current. But generally, if an entity takes an electricity connection, you have to make the deposit. It is expected to be realized only when the entity liquidates. Because normally, entities will not take electricity connection for 1 year. Yes or no? So generally electricity deposit is considered as a non-current asset. Okay. Now tender deposit, earnest money deposit. So this tender deposit or this money deposits are made for participation in the bids. And if I can get the amount back only if I lose that bid. So, but that depends on the terms of that deposit. So, what you should write or what in the study material, what they have written is, it is depending on the terms of the deposit. If the entity expects to realize it in 12 months, current or else non-current. A diplomatic answer. That's it. GST deposit. GST deposit under dispute. Again, expected to be settled within 12 months or realized, expected to be realized within 12 months, current or else non-current. Okay. Illustration 12. As per Ind AS 1, paragraph numbers I am purposefully ignoring. An entity shall classify a liability as current when it expects to settle the liability in one operating cycle. An entity develops tools for customers and normally it takes 2 years for completion. The material is supplied by the customer and hence the entity only renders service. For this, the entity receives payment upfront. and credits the amount to income received in advance. Okay, okay. I got an order, but I can finish that work only after 2 years. But I already received the payment. So I pass the entry bank account debit to liability, that is income received in advance. So it's a liability. So what is the treatment of this liability? Current or non-current? It is current. But 2 years is the operating cycle, right? So it is current. Normally, income received in advance would be classified as a current liability as it is part of the working capital, which the entity expects to earn within its normal operating cycle. Okay. Now, question number 13, I'll mark as very important. This is Institute's favorite question. Yeah. Illustration 13, illustration 14. These two questions are our institute's favorite questions. They used to ask this repeatedly. An entity has taken a loan facility from a bank that is to be repaid within a period of 9 months from the end of the reporting period. I have taken a loan which is to be repaid within 9 months. So it is current. Okay. Prior to the end of the reporting period, the entity and the bank enter into an arrangement whereby the existing outstanding loan will unconditionally roll into new facility which expires after a period of 5 years. Okay, so 31st March is the end of my reporting period and this is expected to be settled within 9 months from the end of reporting period. But before 31st March, we already entered into an arrangement to roll over of this loan, which expires after a period of 5 years. How should such loan be classified in the balance sheet of the entity? It has become non-current. Because prior to the end of the reporting period, the entity and the bank enters into the arrangement. The existing outstanding loan will unconditionally roll into the new facility. So, and 5 years time is there. So, of course, it has become non-current, right? Will the answer be different if the new facility is agreed upon after the end of the reporting period? Yes. On 31st March, it is current. So, after if you enter into an agreement, it is a non-adjusting event. No conditions were existing. Yes or no? So, it is a current liability. Will the answer to A be different if the existing facility is from one bank and new facility is from another bank? Yes. You have rollover, but first you need to rollover means first you got time for 5 years, but first you settle bank A, then only you will get so it is like you should take the loan from bank A and settle bank B. So which means existing loan is current, it is to be settled immediately. So it is yes, current. Why you said it is yes? Because initially my answer is non-current. Will your answer is different? Yes. Will the answer to A be different if the new facility is not yet tied up with the existing bank, but the entity has the potential? Yes, you have not entered into any arrangement, so but you have the potential. So at the end of the reporting period, it is current. I hope this is clear. In December 2011, an entity entered into a loan agreement with a bank. Okay, the loan is repayable in 3 equal installments starting from December 2015. So you are in December 11, you have taken a loan and it is repayable only after 4 years. One of the loan conditions is that an amount equivalent to the loan amount should be contributed by promoters by 24th March 2012. Okay. There is a condition that if the loan amount is 1 crore given by the bank on 1st December 2011, by 24th March 2012, promoters also should contribute 1 crore to the company. That is just to ensure that the promoters have funds, the company is stable. So, one of the loan covenants states that the promoters also should contribute the same amount by 24th March 2012, failing which the loan becomes payable on demand. Okay. On demand means immediately. On 24th March 2012, the entity has not been able to get promoters' contribution. If the company was able to get promoters contribution, then there is no relevance for this point or for this question. So as on 24th March, the entity has not been able to get the promoters contribution. On 25th March, the entity approached the bank and obtained a grace period up to 30th June to get the promoters contribution. The bank cannot demand immediate repayment during the grace period. So as on 31st March 12, how should the entity classify the loan? Okay. Now listen. 31st March 2012 is the reporting date. Yes. And before this date, there is a breach of a loan covenant. Okay. Now, there is a breach. And on the date of breach, the loan has become current liability. Yes or no? The loan has become current liability. And the very next day, the company is getting a grace period. Grace period of how many months? Grace period up to 30th June 2012. What is the provision? Let me discuss the provision. The provision is, now listen, this is the provision. I want you to learn these lines. See, an entity classifies the liability as non-current if the lender agreed by the end of the reporting period to provide a grace ending at least 12 months after the reporting period, within which the entity can rectify the breach and during which lender cannot demand immediate repayment. I didn't understand this. Okay. So 31st March 2024 or 25 or 12, whatever reporting date, before that there is a breach, and as a result of that breach, the loan has become current liability. Now the bank has given a grace period. How many months grace period? If the bank has given at least 12 months or more grace period, during that grace period they cannot demand repayment. If the grace period is minimum 31st March 13 or more, then it would have been treated as non-current liability. But here in this case, the grace period is only up to 30th June 2012, which is just 3 months. Therefore, the loan should be classified as current. Did you get that? There is a breach of loan covenant. As a result, it has become current. Now, can you recognize it as non-current? No. You can recognize it as non-current only if the bank has given a grace period of at least 12 months or more. But here in this case, there is no 12 months grace period, just 3 months. Hence, it should be treated as current. I hope that is clear. Now, assume that in anticipation that it may not be able to get promoters contribution. Assume in anticipation, that is 24th March, you need to get the promoters contribution. In the anticipation that it may not be able to get promoters contribution by due date in February 2012. Before this due date, in February itself, the entity approached the bank and got the compliance date extended up to 30th June 2012. So there was no breach at the end of the year. Yes or no? The reporting date, there is no breach. We got a grace period, but that is not the grace period after breach. We are asking for the grace period before the breach. So on 31st March, there is no breach. Therefore, on 31st March, the loan is of what nature? Non-current liability. So on 31st March, I will recognize the loan as non-current because there is no breach. At 31st March, there is no breach. Therefore, it is treated as non-current. Okay. I hope that's okay. The same question is there in TYK. So that question I may not be taking. Just go through the question and answer. That's fine. Now, OMN Limited, okay, has a subsidiary MN. OMN Limited provides a loan to MN at 8% interest to be paid annually. The loan is required to be paid whenever demanded back by OMN. Okay. So before, payable on demand means when there is a breach, it is payable on demand means it can be immediately asked. But generally, I am giving you 10 rupees and telling, give me 8% interest every year. And when I ask, return the payment. That doesn't mean I will ask immediately. So again, the loan, let me continue the question. How should the loan be classified in the financial statements of OMN? Will it be any different for MN? See, generally a holding company giving loan to subsidiary company and required to be paid only when it is demanded cannot be assumed to be current. Okay, in substance, it is in long-term nature, so it should be classified as non-current asset by OMN Limited. And now, in the answer, you should also write if it is expected to be paid within 12 months, then it should be current. And in the books of MN Limited, MN Limited should recognize it as current liability. But why should recognize it as current liability? I have not understood. I have not understood why it is current liability. You have not understood, right? Yes. So what is current, non-current? Say current expected to be settled within one operating cycle, okay. Held primarily for trading, okay. Due to be settled within 12 months, okay. The entity does not have unconditional right to defer settlement for at least 12 months from the end of the reporting period. What is this point? Entity does not have unconditional right. So whether our MN Limited, MN Limited is the subsidiary. If OMN, right, OMN holding company, if they demand payment, whether MN Limited has the unconditional right to defer the settlement of the liability for 12 months? No. If they demand, they should give the payment immediately. So in the books of MN Limited, it should be treated as current. Okay, it should be treated as current. Okay, I'll read the answer. Here, OMN would classify the loan as current asset. Listen, OMN would classify the loan as current asset if both parties intend that it will be repaid within 12 months. MN would classify the loan as current because it does not have the right to defer the payment for more than 12 months, regardless of the intention of both parties. Okay, fine, understood. Now, there is a question. Last illustration 16 is a format. I don't know whether they will test you the format, but expect. As long as this illustration 16 is there in your study material, they can ask this question. Listen, if you have done business combination, consolidation, balance sheets, this is very easy. A Limited has prepared the following draft balance sheet. They have given cash first, cash and cash equivalents. So this I need to present as cash and cash equivalents under current asset and disclose it as financial asset. Yes or no? I'm not preparing the balance sheet. I'll just we'll discuss the adjustments. Now, what is this? NCI's interest share of profit for the year. NCI's share of profit. I don't know. Dividend declared and paid by A Limited. Dividend declared and paid. So it is already paid. Now reduce it. Dividend declared and paid will be shown in the notes to accounts. Reduce from profits in the notes. In fact, NCI's share of profits also reduce it from the total profits. NCI's share of profits should not form part of your profit. So that is to be, ideally it has to be reduced. Accounts receivable, financial asset, inventory at cost, inventory, current asset inventory. Inventory at fair value less cost to complete and sell. Oh, inventory at fair value less cost to complete and sell. To complete means it is WIP, work in progress. So both inventories will be presented as inventories. Investment property, okay. PPE, fine. Long-term debt, 500 crores due on 1st January each year. A long-term debt is given, but of which 500 is Due at the end of each year means that is in the nature of 500 due at the end of each year, that is in the nature of current. Balance, so 3,300 minus 500, 2,800 is non-current. 3,385 is non-current. Okay. Interest accrued, current. Share capital. Actually, in this question, there is a problem with regard to alignment. Okay. Share capital is this. Retained earnings is this. Profit for the year. NCI. Accumulated depreciation. So, share capital, okay. I'll just present in the balance sheet. Retained earnings, other equity, opening retained earnings, current year profits, less dividend, less share of NCI's profits. NCI will show present NCI. Accumulated depreciation on PP will reduce from PP. Provision for doubtful debts will be reduced from PP. Will be reduced from accounts receivables. Trade payables is this 880, 790. Accrued expense. Warranty provision for 12 months from the date of sale. Generally current. Environmental restoration provision. Restoration expected in 2016. Oh, what is the current year? 10, 11. So this is non-current liability, long-term provision. Non-current liability, long-term provision. Provision for accrued leave. Provision for accrued leave is generally current. Dividend payable is also a current liability. Prepare consolidated balance sheet using current and non-current classification in accordance with Ind AS 1. Assume operating cycle is 12 months. Okay. So I'm not preparing the balance sheet as such. We'll discuss the figures. Please have a look. Focus. PPE. From where did you get this figure? So let me take PPE. 5,200, 4,700. 5,200, 4,700. Deduct accumulated depreciation 1610, 1240. So if you have the calculator, 5,200 minus 1610, 3590. 4,700 minus 1240, 3460. Yeah. Okay. Investment property. Investment property. Just copy paste 3100, 3100. Maybe that is land. No depreciation. And it is same cost model. Land cost model. Yeah. 3100, 3100. No change. Current assets inventory. Inventory. Just take the total 1,680, 1,780. Yeah. Inventory 1,680, 1,780. Are you guys following? Is it okay? Trade receivables, you should deduct provision. So trade receivables, uh, aging more than 12 months, less than 12 months, I need to show actually. But here there is nothing. This accounts is 2,300, 1,800. 2,300, 1,800. Less 265. 2,100. 1,735. Cash and cash equivalents, no adjustment. Share capital, same. Other equity. From where did you get this figure? Other equity. Let me check. Other equity. Other equity opening 1,000, not opening, 1,875 and 1,740. Current year profits 1,200 and 830. And NCI share 160, 150. NCI shares 160, 150 and dividend declared and paid 90 and 70. So there is a dividend declared but not paid, that will show under current liability. So here 1875 plus 1200 minus 160 minus 90, 2825. 2825. 2350. It is matching, right? NCI given. I've taken the figures given. It is given. Long-term debt. We deducted. Do you remember 3300 minus 500 we deducted? 3885 minus 500. Long-term provision. Just copied and pasted. Trade payables. Long-term debt. Not long-term debt. Current portion of a long-term debt. Interest accrued given. Dividend payable. Provisions given we have taken. That's it. Some financial liabilities, provisions. So that's it. So a balance sheet can be asked. So don't take a chance. Just be clear. Maybe we have taken 10 minutes for this question. So illustration 16. With that, the standard illustrations are finished. Now TYK. TYK we have now only 5 questions. Of that, one question is common. Let's quickly finish. TYK question number 1. First question. An entity manufactures passenger vehicles. Okay. The time between purchasing raw materials to manufacture the passenger vehicles and the date the entity completes the production and delivers it to the customer is 11 months. Customer settles the dues after a period of 8 months from the date of sale. Oh, so 11 months and collection period is 8 months. So 19 months is the operating cycle. So will inventory and trade receivables be current? If it is expected to be realized within 19 months operating cycle, yes. Assume the production time is 15 months and time lag between the date of sale and collection is 13 months. Then your operating cycle is 28 months. Is expected to be realized within 28 months, it is current. Okay. Now question number 2 is same as illustration 14. You please go through every information, even the dates are same. That is why I am not reading. Dates are same, December 11, December 15. I don't want to repeat the whole story. Now, company A has taken a long-term loan from company B. In the month of December, there was a breach of material provision of the arrangement. Okay, we have taken a loan and there is breach. As a consequence of which the loan becomes payable on demand. In the month of May, the company started negotiation. After the reporting period, they started negotiation. So on the date of reporting, the loan has become current. After the reporting date, the company started negotiation not to demand payment. The financial statements were approved for the issue in the month of June 2012. In the month of July, both the companies agreed that the payment will not be demanded immediately as a consequence of breach of material provision. Financial statements were approved on June. Anyway, what is the answer? Now, here what is to be done? Listen, if there is a loan and there is reporting period, reporting date. There is breach. Loan has become current liability. No grace period equal to or more than 12 months. Then the loan will be treated as current liability. There is breach. On that date, it has become current liability. At the time of breach, it has become current liability. Now, grace period equal to or more than 12 months. Then it has become non-current liability. Now, there is breach. On the date of breach, it has become current. There is rectification before approval date. Non-current liability. Breach, current liability. Rectification after approval of financial statements. On the balance sheet date, so classification on balance sheet date, on reporting date. No breach before reporting date. There is no breach before reporting date. Then definitely definitely non-current liability. Are you clear? I hope this is okay. So what is the classification of liability? Liability is current. So if there was no breach, non-current. If it is breach, current, but rectified before the date of approval, still it can be non-current. Or if there is breach and we got a grace period more than 12 months, it is non-current. Are you clear? Now, entity has undertaken various transactions in the financial year ended 31st March. Identify and present the transactions in the financial statements as per Ind AS 1. Okay. Remeasurement of defined benefit plan. For this, you should have studied Ind AS 19. Actuarial gains or losses will be transferred to OCI, which will be reclassified to retained earnings. Just OCI is enough here in this answer, but it is an OCI item which will be reclassified to retained earnings. Current service cost is again Ind AS 19 DBP, current service cost defined benefit plan, will be taken to P&L. Change in revaluation surplus. You should have studied Ind AS 16, which is transferred to OCI, will be reclassified to retained earnings. Gains and losses arising from translating monetary items in foreign currency. Don't jump into conclusions. Monetary assets translation, debtors, loans translation, the foreign currency gain or loss will be transferred to P&L. But somewhere we have studied OCI, FCTR. Yeah, that is foreign operation. Translating foreign operation, it will be transferred to OCI, which will be later reclassified to P&L. Gains and losses from investments in equity instruments designated as FVT OCI. So that will be, of course, fair value reserve in OCI, which will be reclassified to retained. Income tax expense always to P&L. Share based payment cost always to P&L. Okay. Now XYZ Limited, a company, is into manufacturing of tractor parts and mainly supplying components of original equipment manufacturers. Okay, we are into manufacturing of some parts. The company does not have subsidiary, joint venture, associate. Okay. During the preparation of financial statements, the accounts department is not sure about the treatment or presentation of below mentioned matters. Accounts department approached you, so they have some doubts. Could you please clarify what are the doubts? There are qualifications in the audit report of the company with reference to 2 Ind AS. We should say even if there are qualifications, the entity should present explicit, unreserved statement of compliance with all Ind AS. With all Ind AS. Okay. Entity should not make this disclosure if the entity has not complied with the Ind AS. Okay. Now, is it mandatory to add the word standalone before each of the components of financial statements? No. This entity, as it does not have a subsidiary, associate, joint venture, it should use the word individual financial statements. The company is Indian company and preparing and presenting the financial statements in rupees. Is it necessary to write? Yes, is it necessary to write the financial statements have been presented in rupees? Yes. Presentation currency. You need to disclose, which we read initially. Presentation currency should be disclosed. The company had sales transactions with 10 related parties during the previous year. However, during the current year, there are no transactions with 4 related parties out of the 10 aforesaid related parties. So, we had last year 10 related party transactions. For example, current year we have only 6. There are no transactions with that 4 parties. Hence, company is of the view that it need not disclose sales transactions with these 4 parties in related party disclosures because with these parties there are no transactions during the current year. Is it allowed? What is your take on this? You should say minimum 1 year comparatives of balance sheet, P&L and notes, cash flows, everything is compulsory. Even if there is no transaction with that 4 parties, disclosure is required for the previous year. That is compulsory. So that's it. Finished. You can read, go through the answer. Let's quickly take this practice questions also. Only 6 questions you have. A company presents financial results for 3 years. Okay. Company presents financial results for 3 years. One for current year and 2 comparative years. Oh, internally for the purpose of management information every year, in addition to general purpose financial statements. So they prepare financial statements and also they prepare balance sheets or financials. Company presents financial results, which means statement of P&L for 3 years. Company prepares statement of P&L for 3 years. The aforesaid financial results are presented without furnishing the related notes because these are not required by the management for internal purpose. During the current year, management thought why not they should present the third year P&L also in the general purpose financial statements. It will save time and will be available easily whenever management needs this in future. So management needs 3 years P&L, but for as per Ind AS 1, minimum 2 years only required. So they thought they will present that additional P&L also. With reference to the above background, can the management present third balance sheet of P&L? The answer is a big yes. Minimum requirements are mentioned in Ind AS 1. If maximum you are presenting, well and good, that's it. Yes. Now, if management present third P&L in the general purpose financial statements as comparative, is it necessary that the statement should be compliant of Ind AS? Ind AS is talking about current year, previous year, minimum information. So, when you present a third year, is it required to be Ind AS compliant? Of course, it should be Ind AS. Then only it will help us in comparisons. Yes or no? It should help us in comparison. That is why it is called as comparative. So it should be Ind AS compliant. So yes. Is it necessary that yes, yes. Can the management present third P&L only as additional comparative in general purpose without furnishing the other components? Yes. You are not presenting cash flow, statement of change in equity, third balance sheet or third cash flow is not prepared. Is it okay? Yes. Only P&L. Because Ind AS is talking about only the minimum requirements. Maximum, it's okay. Welcome. That's it. Now, a company while preparing the financial statements for 11-12 erroneously booked excess revenue of 10 crores. Oh, so revenue more by 10 crores. The total revenue reported in 11-12 is 80 crores, which is actually 70. But you recorded 80. However, while preparing the financial statements for 12-13, it discovered the excess revenue booked, which it now wants to correct in the financial statements. However, the management of the company is not sure whether it needs to present third balance sheet. Come on, guys, whether they need to present the third balance sheet? No, because it is not affecting the beginning of previous year financial position. Yes or no? Is it affecting? Because previous year only the effect, current year and previous year only the adjustment needs to be done. Beginning of the previous year there is no effect, so no need to prepare third balance sheet. Okay. So with regard to the above background, is it necessary to provide? Yeah, that is what we said. The company wants to correct the errors during the year 12-13 by giving impact in the figures of current year only. So they decided 11-12 there was a mistake. 12-13 they decided to correct. But current year only they are giving the effect. Are they required to adjust the previous year? Of course, previous year correction should be done. No need to prepare the third balance sheet. That's it. Correction should be done for the previous year, but no need to prepare the third balance sheet. Okay. XYZ, the company, is into construction of turnkey projects and has assessed its operating cycle to be 18 months. So company is into construction and operating cycle is 18 months. It has certain trade receivables and payables which are receivables and payables within a period of 12 months. Okay. But operating cycle is 18 months. There are some information given. You need to give the provision. You need to give the answers. The company has some trade receivables which are due after 15 months from the date of balance sheet. The company expects the payment to be received within the operating cycle. Is current, not yes. It is current. Current. The company has some trade payables which are due for payment after 14 months from the date of balance sheet. These payables fall due within the period of operating cycle. Though the company does not expect that it will be able to pay these payables within the operating cycles, because the nature of business is such that generally projects get delayed and payments from customers also get delayed. Oh, but as on today, it is current. As on today, it is in the nature of current. It is expected to be realized within 12 months. But there can be issues. But now as on the 31st March, it should be disclosed as current. The company was awarded a contract of 100 crores. As per the terms of the contract, the company made a security deposit of 5% of the contract value, 5 crore, on 31st March. The contract is expected to be completed within 18 months. Therefore, said deposit will be refunded back after 6 months from the date of completion of the contract. So this will be repaid only after 24 months. But my operating cycle is only 18 months. So can you treat it as current? It is non-current. Company also has given certain contracts to third parties and have received security deposit of 2 crore from them. Okay. I have given contracts and I have collected a security deposit of 2 crores which are repayable on completion of the contract, but if contract is cancelled before 18 months, it becomes payable immediately. However, the company does not expect the cancellation. Contract of 18 months. So it is current only. Considering the above items or transactions, answer the following. Company wants to present the trade receivables as current despite the fact that the receivables in 15 months time. Thus the decision of presenting the same as current is correct. Company wants to present the trade receivables as current. Yeah, it is correct. Yes. And show aging, that is receivable within 12 months, receivable for more than 12 months. You need to show the disclosure. If it is trade receivables, aging has to be done. The company wants to present the trade payables as non-current despite the fact that these are no, it is current. We already explained the reason. Because it is expected to be received within the operating cycle, within actually 12 months. What is given? Expected to be received within 14 months. But there can be delays. But still it is to be treated as current. Can the security deposit of 5 crore made by the company with the customer be presented as current? No, of course, it is non-current. Because it is expected to be received only after what is given here? 18 months plus 6, 24 months. 2 years you need to wait. But your operating cycle is only 18 months. No. Now, can the security deposit is non-current? No, it is current. Because it is expected to be received in 18 months. Okay. Is offsetting permitted? Generally, offsetting is not permitted unless there is a legally enforceable right. You can do offsetting only if it is not affecting the substance of the contract. Expense incurred by holding company on behalf of subsidiary. which is reimbursed by subsidiary. Whether in the separate books of holding company, the expenditure and related reimbursements can be set off. No, you should show the expense incurred and reimbursement. Separately, you need to show. Okay. Whether profit on sale of an asset again adjust against loss on sale of another asset. Generally, profit on sale and loss on sale can be set off, but if it is generally, it can be set off. But you should show it separately if it is material. If it is material, it should be shown separately. If material, no offsetting. Or else PPE sale gain and loss can be adjusted generally. In P and L, it can be adjusted. When services are entered in a transaction, see, when you have a doubt, you always write this. If there is legally enforceable right to set off, it can be set off, or else it cannot be set off. Offsetting should not adjust the substance of the transaction. Offsetting should not affect the substance of transaction. So when services are rendered in a transaction with an entity and services are rendered received from the same entity in two different arrangements, can the receivable and payable be set off? You have given service to the entity and you have taken service from another from the same entity in a different arrangement. So here what you should write is if there is legally enforceable right to set off. Legally enforceable right to set off, then set off is permitted, or else set off is not permitted. Okay, that you will write. That's it. An entity has the following trial balance line items. Receivables, it is current. Advance to suppliers is current. Operating nature expected to be done in one operating cycle, current. Income tax receivable, if it is expected to be received in one operating cycle, current, or else non-current. Insurance spares. See, this spares, standby equipment, if it is expected to be used for more than 12 months, it is PP, or else it is inventory. Let's forget this paragraph numbers. As per Ind AS 1, an entity shall classify an asset as current, expects to realize or expects to trade it, or with expected to realize within one operating cycle. The guidance current assets, okay, fine. The receivables are considered as part of normal operating cycle, therefore current. If it is more than 12 months also, it should be disclosed, but it still be current. Advance to suppliers is generally current. Same kind of answering. Income tax receivable based on the if the entity expects to realize within 12 months, then current, or else non-current. Spare parts, standby equipment, servicing equipments are recognized as per Ind AS, which they meet definition of PPE, or else it is classified as inventory. So insurance spares that are treated as item of PPE, non-current, or else it is current. Easy, right? And the last one, question number 6, or small question. As per the statutory requirement, exceptional items are required to be disclosed, whereas Ind AS 1 requires separate disclosure of material items. Ind AS 1 has not defined exceptional or extraordinary items. If it is material items, it should be disclosed. So what do you mean by is exceptional equals material? An item is considered as material if it's omission. Material means if it is omitted, omission, omitting, or misstating or obscuring. If I omitted, I have not taken it, it is expected to influence the decisions that primary users of general purpose financial statements make on the basis of those financial statements. Guys, this is what you have learned in your 11th standard also. An item is considered as material if it affects the decisions or if it influences the decisions of users of financial statements. Same thing. Materiality is based on the nature or magnitude of information or both. Okay, fine. I'll give some examples for material. So following items are exceptional, but if it meets the criteria of materiality, then disclose. Write down of inventories to NRV. Impairment loss or reversal. Restructuring. Maybe the amount is less or amount is more, but the inventory value has reduced, or there is a restructuring, there is a sale of PPE. All these are material items that requires disclosures. Okay. Then what else theory we have? Theory is just format of balance sheet. What is OCI? Let me run through. After this, frequency, the rest of the theory, frequency in financial reporting, at least annually. If you're preparing financial statements, longer or shorter, reason and fact should be disclosed. Comparative information is compulsory. 1 year comparatives are compulsory. There should be consistency in presentation. What are the items in balance sheet? What are current assets? Share capital disclosures. What is statement of P&L? What is OCI? OCI will be classified to P&L, will not be reclassified to P&L. Some items in OCI is given. What is statement of change in equity? It is basically a reconciliation statement reconciling opening equity and closing equity. Statement of cash flows you should prepare as per Ind AS 7. Notes to accounts. That's it. That takes care of Ind AS 1. So just go through the questions, just go through the theory. Don't invest too much of your time. As I said initially, just relax and watch this lecture. That takes care of Ind AS 1. So I wish you a good day and we'll meet with another Ind AS. Thank you everyone.